Welcome to the deep dive video update. This is a video that I do every week where I pick out some of the charts that maybe I didn't use all that much in the daily videos. I also have some charts that are unique just to this particular video. That's why I call it the deep dive video, because we have to look deeper to see, are we getting any clues from these charts? And this is being prepared for Monday, August 11th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. The first chart is mainly for information, but it's a long-term look at the VIX. Now, the VIX is on here, but it's turned invisible. Over top of the VIX is a 50-period exponential moving average. In a general sense, when we're in a lower range and actually declining, that's more positive for the market. When the VIX is going up, that's more negative, and we tend to work into a higher range. Now, we were going up. Earlier in the year, we had a big downward move in March and into April, and the VIX was really going up during that time. And then we've been rolling over as we've been coming up out of those lows. Now we're ticking up just a little bit with the latest reading here. But for the most part, the takeaway from this is we're going down and we're below 20. So the long-term VIX here is still remaining positive for stocks. All right, and we want to measure the speed of the VIX on a shorter term time frame. This uses a short-term RSI based on 9 periods. And I did use this not too long ago. When we had that down day a week ago Friday, the VIX really spiked up because we actually closed above 20 with the VIX. Well, we recovered from that. The VIX started to drop, and so did the RSI. And so now we're in a more neutral reading with the VIX here. And we were getting some high readings with the skew index, which is a variation of the VIX. The VIX uses at-the-money options, whatever the current price is. They calculate calls and puts to come up with the current value of the VIX. Well, the skew index looks above current price and below current price to come up with its calculations, and that's called the skew index. And when we get up into this red area, the market's expecting some kind of a big move. We came up here, fell back down, then we went back up again, then we fell down. Now, a big move could still be on the way. I just stopped showing this chart after we come back out of the red area. And it doesn't necessarily show us whether it's going to be an upward move or a downward move. We have to use other charts to give it more context. But this is coming back down into a more neutral reading currently. We look at a correlation between the VIX and the S&P. When we get above the dashed line, that's when we get concerned. We're still getting a low reading here. Then we look at the VIX, and then there's like an indicator of the VIX. It's like the VIX of the VIX. So how volatile is the VIX itself, and then do a ratio between those two. And in the context that we're looking at now, this has been going down. That means the VIX is going down faster than the volatility of the VIX. And that's when stocks are more positive in this context. There's other times when this went down and we still would go down for periods of time. And here, this is when it went up as we were going down throughout the bear market in 2022. So we have to kind of pick out what is the context of it at any given time. The Ulcer Index, another measure of fear in the market. I only start showing this when we get above the moving average and we're still below it. We look at the volatility of stocks and the volatility of bonds and then do a ratio between the two. Now we're picking back up a little bit here as we were coming up out of the lows in April. This red line continued to go down, and that was more positive for stocks. That means the volatility of stocks was going down faster than the volatility of bonds. We are going back up just a little bit here. We'll see if it will resume going down or if it starts to go up. That might mean some more fears coming into the market, especially when you compare fear in the stock market versus fear in the bond market. Looking at the large caps and doing a ratio with the small caps, not an awful lot of change here. We started off pretty solid here where the large caps were doing better, and that's when this ratio goes up. And then we got into about April or so, and we've just been chopping sideways overall with this ratio. This is just for informational purposes. These are the percentage gains going back to significant lows that were set back in 2022, 2023, and then the low set in April of 2025, and how much we've gone up percentage-wise since that time. And we want to keep an eye on the 200-day simple moving average. We're still below this dashed line here, which is set at 10%. If we get above that, that's when we're getting kind of far away from the 200-day moving average. Now we can still go down at any time. But you can see other times over the last few years, back in 2023, we got above this, and then we had a correction after that. Then we had it happen a couple of times in 2024, led to a pullback here, also led to another pullback in July of 2024. So we could go down. There's really nothing magical about this. It's just when we get far away, that's when we pay attention to it the most. Looking at anchored moving averages, and these are usually drawn from significant highs or lows. And I have a more recent one here. This is the breakout when some positive news about the trade deals came out, and we finally were able to break to the upside. And we're still above that when you look at this anchored moving average from this position here. If we start to fall, which we've been looking pretty good here, you can see higher highs, higher lows with the bars, but you could also make a case that this might be a bear flag. Like, now, I'm not a big pattern person, okay, but you can clearly see that here, that we haven't been able to exceed this previous high. And if we do see some more weakness, it could actually turn into significant weakness here. But the first area that we'll be watching will be this particular anchored moving average. Now, there's other moving averages. There's other anchored moving averages here. There's lots of support above current price. And what we try to pick out is, okay, what is the most viable area of support if we do start to fall? We watch that, see if it holds, and then look to see if things are actually improving. All right, and then we look at the cumulative advanced decline line for the S&P based on price. Now we're close to an all-time high. We didn't set an all-time high on Friday, but we're close. You can see we're lagging a little bit here based on price. We're also lagging here based on volume. Where the NASDAQ and NASDAQ 100, they did set new all-time highs in Friday's session. So there's a little bit of a negative divergence here. We look at a short and intermediate term advanced decline ratio. Now, I show this in the daily video, but it looks different. It's a red line and a blue line. This looks at the short term one, the 19-day advanced decline ratio. And we also add volume to the mix down here. And when we're above zero and going up, that's more positive. So, which is what we're doing right now when we're actually above zero and seeing an improvement here based on volume as well. Then we look at a 10-day average of the highs and lows for the S&P. Now, that's a lot longer term, and we can use this like an oscillator. Now, you notice that we've been going up, but this has been going down. That's another negative divergence that we're seeing. It's longer term. It's not picking up a lot of the strength that we saw throughout this past week. So if this continues to fall, it's still positive until we get down to 50. But we look at the context. If it continues to decline, that could suggest that there's weakness starting to build in the S&P that's longer term. And we look at a cumulative advanced decline line for the NYSE, not back to an all-time high yet, but we're still above the moving average. And then we look at a regular NYSE advanced decline line. It was pretty much flat in Friday's session, but still above the moving average. This is another NYSE advanced decline line, which is calculated in a slightly different way. It was pretty much flat as well, but it's positive. We're in an uptrend and we're above the 50-period moving average. Then we break it out just based on stock. The NYSE common stock up here is price, and you can see not much of a change here. And we also went down just a little bit here with the the common stock advanced decline line based on volume. Okay, then here's another broad market, little longer term look. This is a 5-period moving average of the highs minus the lows, and this has also been declining. Now, we ticked up just a little bit in Friday's session, but overall, we had seen this stronger, and the broader market was participating more. Now we're starting to see this fall back a little bit. If we drop down below this blue line, that would actually turn this negative. Long-term, large cap growth. This is still looking good, but we didn't set a new all-time high. We're still not above this high that was set it was a week ago Thursday when we gapped up and then spent the rest of the day coming down, and then we gapped lower in Friday's session when the employment report came out. So we have been trying to bounce back up. We filled this gap. Now, here's another look at a potential flag, a bearish flag, you could say, if we start to drop from here. Now, we could continue to go up and possibly set a new all-time high as well, but this is still looking positive, but wasn't really solid. In Friday's session, what really drove the indexes up, mainly Apple. Apple was having a very good week, but it was a few of the mega caps that had really good sessions. Then we look at momentum stocks, kind of leveling out here. They have been improving as we worked our way through July and into August. And I really just use this for informational purposes because you can notice here when we were really going down in March and into April, this was really going up. So these stocks tend to hold up better and actually go up when compared to the rest of the S&P 500 on a ratio basis. And then as we've been going up with the S&P, this ratio has actually been going down. We look at another ratio between US and international stocks. We're trying to make a subtle little improvement here as this has been going up after setting up a bit of a base. But US stocks still continue to underperform. And that's what we saw earlier on in 2025 when this ratio was really going down. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Then technical alerts, these are put out by stockcharts.com. This is for the whole week. On the bottom is Monday. On the top is the last alert that was issued on Friday. And as a general rule, if it's red, or we're seeing green here, if it's red, that's negative. If it's green, that's more positive. And we can just kind of look from a color perspective to see whether it's a positive or negative day. Then we look at 6 different indexes, and then we rank them on a scale of 0 to 100. The higher the score, the better looking that particular index. Coming in first place is the NASDAQ right now at 86.2. It's doing quite well. And if you watch the intermarket analysis video, we've been seeing now for quite some time where the NASDAQ is actually outperforming the NASDAQ 100. They both set all-time highs on Friday, but the NASDAQ has actually been outperforming. Then in second place is the NASDAQ 100, as represented by the QQQs, coming in at 83.9. In third place, which is the S&P, which has growth and value, that's why it tends to underperform when we're going up. It's coming in at 72.1. Then we have the Dow. Not looking all that good, 26.3. It's really not looking all that good from a technical analysis perspective, according to this score. Then we have small caps, which had a pretty good week, but they're still coming in at 18.7 and now in last place. They kind of go back and forth between the small caps and the mid caps, but this week are the mid caps at 13.1. And they've really been underperforming. Small caps actually had a better week. All right, then a short-term rainbow going from 10 periods up to 50 periods. We're still above the rainbow and all the lines are going up. This just confirms that the short-term trend continues to be positive. And we have an intermediate term rainbow going from 50 periods up to 100 periods. We're still well above all the lines in the rainbow and the lines are going up. That means this is still positive. We want to keep an eye on the 50 period moving average. Now, a week ago when I did this video, I was also showing the 20 period moving averages. I'm showing those in the daily videos now because if we start to drop down, we'll see if that ends up providing some kind of support. Now, if we fall through that, the next area that I'll be watching will be the 50 period moving averages, both the simple and exponential. Then if we fall through the 50, we'll be watching the 100 period moving average steady here. Another momentum oscillator, the Connors RSI. I only show this when we get extreme positive or negative. I did show this a week ago because we had already gone extreme negative after that big down day that we had. But since then, we've worked that off and we're more neutral. And then this is just percentages. And again, I always like to warn you here. Don't take these percentages as gospel. I just kind of have to eyeball it and you move this a little bit and the whole percentage thing really changes. But this is just giving you an idea. What we're keeping an eye on here is, you notice how we were going up and then we pulled back. If we do start to pull back somewhere along the line, we're going to be watching the percentage of that pullback. Because if we go down over 10% on a closing basis, now this was over 10% back in 2023, but I measure it intraday. The market and the technical definition is on a closing basis. We got really close to a 10% decline and then we came up out of that, because if we go down over 10%, now we've gone into actual correction territory. If we go down over 20%, that is bear market territory. And we got close to that back in April. And just about when we hit that 20% area, that's when the smart money started to come in and buy, and eventually it took some real choppiness here, but we were able to work up out of those lows. We keep an eye on the S&P 100, which is really outperforming the S&P 500 right now, which is okay. And that's what you want to see when the market is doing quite well and looking more positive. The mass index, we're not seeing a signal. We won't see a signal unless we get back up to the red dash line and the blue line, and then it crosses back down below. So there's been no need to show this chart. Standard deviation, this is measuring the speed of how quickly prices are moving, either up or down. And we're still below the moving average. I only show this if we go above the moving average. And the CMB composite, which we were getting extreme positive here back in July, and then we really dropped down from that. We are improving, but I only show this chart if we go above the black line or below the bottom black line. The percent B indicator, this measures if we close outside of the upper or lower Bollinger Band. We're not there now. Now we are positive since we're above the midpoint and going up, but I only show this when it gives extreme readings. And the Pring bottom fisher, we were getting some kind of a signal here. It was getting really close right at the end of July. It didn't seem to really turn into anything. We also had one earlier in July that I guess would have been okay, but we kind of went up and then we were just kind of going sideways for a while there. It's not giving us a signal currently. Point and figure chart, we didn't see enough of an up or downward move in the last week, so there's been no need to show this chart in the daily videos. Now, these two O's that were drawn in, that was after a week ago Friday. We had the employment report, we gapped lower, we closed lower, everybody's freaking out, and we saw the two O's being drawn in here. And this measures O's when we're going down and X's when we're going up, and it doesn't take time into account. It just takes price movement into account. A long-term rainbow going from 50 periods up to 250 periods, we're above all the lines and all the lines are going up. And the more we stay above this, the more these lines will continue to go up, cross over each other again, and look even more positive. Now we're getting really close. And if we go above this red line with the long-term special K daily chart, I'll start showing this for a few days in the daily video. We're just about ready to cross above the red line. Now, I don't show this because the last signal was back in March, and then the signal before that, we didn't see it until it was back in 2023. We didn't even get a signal in 2024. But if you look here at the daily side, this would be more positive longer term if we actually cross above the red line. Now, the weekly chart never did turn negative. It's still positive, and I go through that in the weekly video. If we get above this red line, then we would see the daily chart and the weekly chart confirming each other. And we look at a weekly chart of the S&P on top and the German DAX weekly chart up here, and then the correlation between the two. This is longer term since we use a weekly chart with this, and they're having a pretty strong tendency to go in the same direction at the same time. They're correlated with each other. Then we have the Ichimoku cloud. I don't show this because we're well above the green cloud. A lot of times if we do start to fall, and if there are declines, then I'll start showing this chart again, but this cloud can act as a support area. And we're still positive here with the green line going up, that short term. The blue line, even though it's flattening out here, it's still above the red line. So we have short, intermediate, and longer term here. And unless we cross down below the red line, that's when the longer term signal would be more negative. Then we start to watch to see, are we going to fall into some area in this cloud? But that doesn't seem to be happening, at least yet. And here's some shorter term Fibonacci retracement levels. We don't need this unless we really start to decline. This measures all the way back to the April 2024 lows, if you remember that decline, and then we came up out of that. And this is just trying to find a support area if we do start to decline here. to see, okay, is the market going to pay attention to that? And then this next one is longer term. This actually goes back to the low in October 2022, and you can see we're quite a ways away from it. We're 1,000 S&P points above this. In fact, 1,080 points, even more than that. So there's quite a bit of space up here. So I wanted to show the charts, but unless we really start to scream to the downside, we hit these back in April, but then we were able to come up off of them. But there's really no need to show these charts. Then we look at the VIXen, gotta love that name, which is the VIX for the NASDAQ 100. It measures the volatility. It's also been declining. It declined on Friday because you had the NASDAQ 100 going up and setting an all-time high. We look at the S&P and then do a growth to value ratio here, the Qs, which is growth, and the diamonds, which is the ETF for the Dow. That's considered to be value. And just coming out of being neutral and starting to show that they're going, it's getting a little bit stronger, meaning they're going in the same direction at the same time because we're breaking out here. That just means that this bottom chart, I should say the middle chart, is actually looking more positive. That means growth is outperforming value. And if that could pull the S&P up, that would be more positive. But we would need to see this correlation get a little stronger first, meaning they're going in the same direction at the same time with more conviction. Then the black line is the Dow, the red line are the transports. Transports didn't have a very good week. They've been really going down. They bounced up a little bit on Friday, but they're continuing to underperform the Dow itself. Then we look at regional banks, which are smaller banks, and do a ratio with the financial sector. And we're still not looking really solid here. We're coming back down to the 50-day moving average, but we're in a downtrend. We got back up to the 200-day moving average and then started to come down with this overall ratio. We're a little bit concerned. We're keeping an eye on the financial sector as a whole because going back to about May, it started to really underperform the S&P. We want the financial sector to be strong. Now, if you look at a chart of the financial sector all by itself, it looks great. It's in an uptrend. It held up better when we were going down. It did okay when we were going up. And then we hit about May into June, and it's still doing all right. It's just underperforming the S&P, and that's what's causing some concern. Then here's just the bank ETF, just banks by themselves. Not doing all that great. They are in an uptrend, coming down a little bit here, but still dealing with their 50-day moving average. And then a ratio between energy and the 10-year yield, sideways. Going back to the beginning of 2023, we were not really seeing anything all that substantial in this ratio. We also keep another ratio going between gold and the S&P. We came up to this yellow declining trend line. We spiked up, which matched up with this previous spike and a previous spike going back to 2016. And so far, we've stayed underneath that declining trend line there. And we look at emerging markets and then developed markets. Developed markets would be like the US and the EU, coming down a little bit here. Emerging markets have been a little bit under pressure, but when this is going down, that means emerging markets are underperforming and developed markets are outperforming. It's not the US, it's mainly been Europe that's been holding up better so far in 2025. And we look at the 10-year yield in the US and we subtract the German 10-year yield, and believe it or not, that gives us a line here that we can actually use. And we look at the US dollar index. Now, we're seeing actually an opposite correlation here. They're having a tendency to go in opposite directions, where this line has been coming down. Now, we did come up a little bit here, but lately we've been coming back up with the dollar index, but it hit some overhead resistance. The market likes a weaker dollar, and so we're not seeing a very strong correlation with this chart. This tries to look at the dollar and then the relationship between European bonds in Germany and US bonds, and coming up with this crazy way of looking at this. Here's the German DAX, not really breaking out to new highs. It was actually down a little bit on Friday, but it's still above its 50-day moving average. And when this was really going down, that means that the German market was outperforming the US market. Then we bounced up when things were going crazy back in April, came back down. We've been gradually drifting up here and not really seeing an awful lot of conviction lately. We want to keep an eye on retail. In the middle area, this is the retail chart itself. It's kind of backwards to the way I usually do things here. But we are in an uptrend. We've seen a recent golden cross. We're above the 50 and 200-day moving averages. That's positive. And we're starting to flatten out here a little bit where we had been declining when we do a ratio between the retail sector and the SPY. That had been declining, and at least it's holding up for the time being. Then on the bottom, you can see just with the retail chart itself, we are still above 50 when looking at the RSI. And we look at some different ratios. And the top is a weighted version of discretionary to staples. Not really doing all that good, but not falling apart either, but kind of drifting up for the most part. Then we look at an equal weight version. You see how it really came down in Friday's session? And that includes Tesla and Amazon in there. And Tesla has just kind of been bouncing around its 50 and 200-day moving averages. Can't determine whether it wants to be in an uptrend or a downtrend. So we're a little bit concerned here to be close to an all-time high with the S&P and to see this going down. But we did improve here when we look at tech to utilities. That's growth versus value there. That did improve. But we came down a little bit when you look at biotech to healthcare. But overall, it's been tending to go up. And we have been declining when you look at hotels to utilities. Utilities have been pretty strong. And it's not necessarily that hotels have been weak. It's that utilities have been really outperforming lately, and that's causing this ratio to go down. Then we look at what are called bellwether. These are the real backbone industries in the U.S. The semiconductors, which are holding up okay, but not really breaking out to the upside. Home builders are showing some improvement here, and that's more encouraging because they were really going down earlier on. The transports, they were improving. Now they're starting to pull back. Retail has been bouncing up. It's pulling back just a little bit here, but in the bigger picture, it's been going up. And then the regional banks, as I showed earlier on, the ratio, well, this is just the chart all by itself. It's pretty much going sideways after it had been declining. We want to keep an eye on this area. If the financial sector is giving us some warning signs, we just want to know about that because it could lead to negative things for the S&P. Then some long-term rate of change charts. I use these for informational purposes. This is Friday's close, and then it goes back 250 periods. We're still going up overall. That's positive. This is that same rate of change based on 250 periods, but just a longer-term chart. We're above zero and continuing to go up. And that's longer-term positive. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then I try to look at some different interactions between bonds, both short-term and longer-term, to see, okay, are we concerned about inflation? Are we concerned about interest rates going back up, or are we not? Because you can watch whatever video you want. You can listen to any genius who seems to have the answer, but it's the market that actually tells us what they're thinking. And the first chart that we look at here is cash, which are 1 to 3 month T-bills, because you get like minuscule interest with that. And then we compare that to 3 to 7 year bonds. Now, when this is going up, that means they're worried about inflation and interest rates. Well, you can see here, we're in a downtrend. We ticked up a little bit here, but we've been just kind of meandering more lower in the short term. Then we look at TIPS, which are Treasury inflation protected securities. That's kind of like they're shorter term bonds, and so you can kind of compare them to cash, but they adjust for inflation and interest rates. And when the people are concerned about that, like in 2024, these were really going up. And that means that the market is concerned about inflation and interest rates. Well, you can kind of see here, we've just kind of been meandering around. We were going up, then we pulled back. Now we're going up a little bit, but not really showing any conviction right now when we compare it to 3 to 7 year bonds. Then we look at that same thing, TIPS to 7 to 10 year bonds. So we go further out, really not seeing any conviction. So this is telling us when we take all these charts together, the 4 that we just looked at, that the market's not really overly concerned about inflation or interest rates, at least right now. All right, and we look at the S&P in red and the long-term bond, which is in blue. And we can see their longer-term correlation is starting to level out here after it had been weakening. And they're actually having a tendency to go in opposite directions in the short term. See where the S&P has been going up and the price of the long-term bond has been going down. So that's kind of, and that's kind of more what you would expect, but not what you always see. Then we look at the QQQs, which is the black line here, which just set a new all-time high. And then that same TLT, the long-term bond ETF, well, it's going up for the Qs and down for the TLT. And the correlation was actually getting stronger, and now it's starting to drop back. But they're still having a tendency to go in the same basic direction at the same time. And we want to keep an eye on short-term interest rates, the 2-year yield. The takeaway that I get from this is that we topped out at the end of 2023, and we've been making a series of lower highs and lower lows as interest rates generally have been coming down, and that's more positive. And we keep an eye on the 10-year to 3-month yield curve. We're back to being normal again, which means we're above zero. We keep just chopping above and below. We have some kind of a big move in the market and we go inverted. We have another big move in the market and we go back to being normal. It just can't seem to figure out what it wants to do right now. Now, the reason why we watch this is to see if it's we don't go right when we cross back over here. We generally project it out 6 to 8 months or so that, okay, are we going to go into a recession? But we seem to get one of these triggered and then it starts looking normal again. And so we start the countdown and then it comes back down and it gets inverted again. Now, most people follow the 10-year to 2-year yield curve, and that one's looking fine. That was inverted for quite a while, but it's not inverted now. I also look at the 10-year to 3-month. So I look at both of them. And just because this keeps bouncing back and forth between being inverted and uninverted, that's why I've been keeping an eye on it. And then we do a crazy comparison here. The Eurozone, European stocks versus American bonds. European stocks are still outperforming American bonds on a ratio basis. Then I have these things called possible positive scenarios. This works more like an oscillator, and this is long term. This really came into play earlier on when we were hitting some significant lows, and we didn't quite get down here in 2022, but this looks for extreme positive or negative readings. We're not getting one of those right now, so we can just look at this and say, okay, is this leaning more positive or is it leaning more negative? Well, these are the percent of stocks in the S&P above their 200-day moving average. Now, I have another chart that shows the same thing. It's just we interpret it in a little different way, and it displays in a little different way. If we get above this green line or below the red line, that's when we're extreme. Now, we are still positive with this because we're above 50, but lately we've been seeing this coming down. Now, it did bounce up on Friday, so it's showing a little bit of an improvement there, but we look at the context. If this continues to decline, that's going to be more negative. If this turns and starts to go back up, that would be more positive. And we use that same basic philosophy and look at a 50-period moving average for the S&P, and we are bouncing back up. We're back a little bit above 50, so we're seeing some improvement there. And look at the mid caps, improving just barely above 50 at 51.75, and so still below 50 with the small caps. Even though they had a better week, internally they're not performing any better than the mid caps. And we look at a SPY to Staples ratio. Earlier on, and I actually did a video about this that was posted on YouTube and I posted on the website, this ratio was really coming down and causing some concerns because we were seeing something similar to what we saw at the end of 2021. Now, the S&P actually set its all-time high in early 2022, but this ratio was starting to go down before we even set that high. Then everything fell apart after that in early 2022. So we were just keeping an eye on this, but it was reacting more to what was happening. And then we were able to bounce up out of this and pretty much take care of that problem. It didn't get taken care of until much later, back in 2021. We didn't really start dealing with it until we got into 2023. But this is shorter term. We were looking bad. Now it's back to improving and staying strong. If this really starts to drop, yeah, we're going to get more concerned about things. So thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.